Welcome back to Theya. I'm Joe Consorti. Today we're joined by a very special guest, Greg Crennan, the Chief Economist at Golden Coast Consultants. I'm a longtime follower of his. I'm a big fan of his, and it's about time that I had him on the show for you guys to meet him as well. Greg, welcome to the show.
Hey, Joe, thank you.
Absolutely. So yeah, long time coming, as I said. I want to kick things off with this question. You've had Cassandra in your name on Twitter for a very long time. Obviously, that means someone who predicts disaster. And so as someone who predicts disaster, what do you have your eye on in markets right now? What's catching your gaze?
Well, one of the reasons why that's in my title is that I was one of the very early people and few people that was actually before even 2020 was warning about the deficit and how that was going to lead to massive inflation and how that this is going to be a crisis that the country hasn't really seen since the 70s. And so when the part of Cassandra is that even though Cassandra warns about disaster, many people didn't believe Cassandra. So when I was warning about the inflationary issues, what's causing it, a lot of people were blowing me off as to it not being a concern because from 2009 to 2019, they said, look, we printed all this money. Money supply has gone up from 2009 to 2019 for the past decade. There's no inflation. So what are you talking about that there's going to be this inflation crisis? And then now we're dealing with the inflation crisis today. And that's really because of all the money printing that has taken place, not necessarily recently, but actually possibly over even 2 decades worth of money printing, because a lot of that debt that we financed the Iraq war, war on terrorism, whether or not it was right is another story. But the point is we financed those wars during the first 2 decades. Then during 2009, we financed more things, including things like Obamacare. And all this money had to come from somewhere. And so that was all money being printed. And so that also distorts markets and misallocation of resources. And so that debt that we financed over the past 2 decades is now coming up to be refinanced. And the thing is, when we were issuing all that debt, we were issuing it at lower interest rates. And so now interest rates are much higher. And so that debt is actually costing us even more money, as we're seeing the interest on expenses is actually, I think, almost the biggest expense now, more so than Social Security and the defense budget on a fiscal year. So, that deficit is causing massive implications in the real economy because the government gets our money either from taxation, tax receipts, or they get it from the deficit where they print it. And so when we're printing all this extra money, that's creating more money and not enough goods, causing prices to rise. And so I was warning about this in early 2019 when the deficits back then, or the national debt, was actually, I think, 25 trillion, and now we're at almost 35 trillion, and that was just 5 years ago. And I think right now we're adding something around the lines of 2.5 trillion deficits per year, and with no politician wanting to put their foot down to the ground and stop spending, there is no real way of defeating the problem with money printing.
Very well said. Very well said. What are your thoughts? I mean, now that we're in election year, it seems like the Fed has already talked about cutting. Meanwhile, price inflation is still above their target. Do you think that they're more so talking about cutting because it's an election year, or are they talking about cutting and forecasting rate cuts in order to uninvert the yield curve? Because the yield curve, and I'll pull it up in a second, the 3-month, 10-month yield curve, it's, I think, 1 month away from being inverted for its longest period ever. So why is Jerome Powell talking about rate cuts with inflation still above target? Is it for the banks? Is it for inflation? Do they think it's going to come back down to target faster than we think? Is it because we're in election? Is it all three? What's your take on that?
Yeah, absolutely. So, obviously the greatest main market and economic discussion today is interest rates and when the Fed is going to cut interest rates. I also would just like to say this isn't actually because of free markets, right? So we're in a lot of people think that we're in a free market capitalism society when we're not in a free market capitalism society. And what I mean by that is that the interest rates are set by the Federal Reserve. And so with the interest rates set by them, they determine what the cost of money is, right? So when we go out to buy a car, they determine what the interest rate should be when we need to borrow that money to purchase that car. And so in a true free market, those interest rates would be set by the market. So if we think that interest rates should be higher or lower as a market, those rates would automatically adjust based on what market demand, supply and demand would be. And so when the Fed says we're not lowering the interest rates, even actually as we're seeing the inflation data, today I was just reading the ISM report that 13 of the services reported higher prices. Also, one of the issues is they're reporting higher prices in fuel and energy. They're also reporting higher prices in copper. Now, obviously copper is a huge component of the EV and our infrastructure when we need to upgrade things like our grid. So if copper is in short supply and things like energy, fuel, and diesel are going up, which diesel really runs the country, for more people who need to get more educated on that, and that's a discussion for another day. But these things are rising, and so interest rates may actually should be higher than where they much are currently today. So when you have that dynamic, you're having a stagflation kind of scenario because interest rates, you can have an organization like the Fed control the rates based on data. So if prices are rising and they're trying to tame the rates, well, then they should be raising the interest rates. But instead, they're keeping them flat and even telling the world that they're going to be lowering them in the future. And what that is doing is it's distorting markets because people are making decisions today based on the information they are giving. And now if we do have this continued inflation spike and everyone was anticipating that interest rates would be lower, everyone just went, will be, is massive distortion is what I'm trying to say. And then that is the disaster of following people what they say versus what the actual data is, and that sets up economic problems.
Extremely well said. And where markets are forward discounting mechanisms, they're discounting the information that the Fed has been giving them, which is we're gonna slash rates. And what is the S&P 500 at today? It's at 5280. Completely insane.
Yeah, as far as
We're
the price goes. Yep.
Yeah, it's totally crazy because usually the Fed's counter-cyclical, right? The Fed is counter-cyclical, but right now we're in an economic expansion, and the Fed's talking about cutting interest rates. It's totally backward, and it has me very confused.
Well, the thing is, the way that I see the data is that, the economy wouldn't really be in an expansion if the government has to constantly grow their deficits. So if the economy is expanding, meaning that we're spending more money, we're putting more money into capex, we're building more things, we're producing more things, then the government, because that would be more money being spent, that would mean more tax receipts for the government. And if the government's deficit is rising and not shrinking, or at least staying flat, to me, that's a sign that the economy is actually not doing so well. You actually see unemployment. So the thing that gets skewed with the unemployment data is that California, which by itself is considered like the top fifth GDP in the world, not in the United States, in the world. And so if you look at unemployment in California and California's deficit right now, they're actually exploding higher. And so there's this issue where unemployment is rising, but it's not right now on a scale of the entire economy, but a big portion of it, specifically in California, and also unemployment is now rising in Texas. I think recently their continued claims, if I remember some of the data, is up around 60 to 70% on claims in Texas. So Texas is another big GDP. And then if you actually look at real estate data, Texas and California, they're having their real estate prices decline drastically. And so, when you're looking at these data points, not the whole economy, but two of the largest portions of the economy, which is California and Texas, is experiencing economic difficulties right now. And to me, what's causing those difficulties when they're supposed to be the two largest, GDP parts of the country? Well, interest rates are having an effect. And so when the interest rates rise, you're having this massive decline in capex, You're having companies, bankruptcies are soaring. I mean, you don't go a day without reading the headlines that another company files for bankruptcy. And what happens is that you're having these companies file for bankruptcy. Well, what happens to the employees? Well, they go unemployed. So you're starting to see these, leading indicators. The real estate market, especially like in Texas, you're seeing supply rise. And so when supply is rising, why would someone want to sell their house if they have a low mortgage rate? Well, that's because they're economically distressed for finances and need cash. And if their house is quote unquote worth $1 million, they're going to try and put it on the market so that they can get that cash. But now there's the issue that there's less demand for housing. And so we're seeing mortgage applications, they're down something like 11% on a year over year basis and still down, I think, at near record lows. So demand for housing is at drastic lows. And so if supply rises just a little bit, that's more supply than meets demand. So that means that prices would have to decline to meet current market equilibriums. And so we're starting to see all these misallocation and distortions in the market play out. And because the stock market is currently at a record high, they get away with that we're in an economic expansion. And so, but I think just recently, Calvin Klein reported yesterday that they're going to have weaker 2024 earnings. That's a discretionary. Just today, Ulta is down something like 15%, I think, and it's the worst performer in the S&P. And so what also is starting to happen in the economy is because of the inflation crisis, the discretionary spending, which is things that we don't need, but when we have extra disposable income, we end up normally paying for. So things like clothing, makeup, all the things that aren't needs for society, but wants. Those wants are starting to go down and they're declining. And so all those discretionary companies, we're seeing it in Apple. iPhone sales in Apple are supposedly down like 30% in the month of January and February. Tesla sales, they just came out with their production, their delivery numbers. It was a massive, massive miss. I think something like 11% year over year decline in deliveries. And so that discretionary spending is trickling in through the economy right now. And so the only thing that is going up is food and energy. And so those are the things that we need to survive. And of course, the dollars that we do have as a society are bidding up on food and energy. And we're starting to see the price of gasoline rise. Gasoline, I think, is up 30% year to date. I think a lot of people who would watch this would be seeing the price of the pump rise. And you're also still seeing food prices rise. I think cocoa just hit record highs. Coffee was on the move higher. So you're starting to see these, food commodity prices surge in price because, over the past couple of years and decades, we weren't allocating resources to produce more of the things that we actually need. And we've been allocating that money into things that we don't necessarily need. And so you're starting to see those rebalances in the economy. And with the Fed going back to your original part with the interest rates, is that even if the Fed doesn't cut the interest rates or raise the interest rates, the rates are just high enough to cause stagflation, meaning like it's really not high enough to tame inflation and it's really not low enough to stimulate economic demand and growth. So you have this stagnation where it's like things are kind of growing, but other things are kind of weakening. So, and that's kind of the other stagflation scenario is that they really don't have the courage or the Paul Volckerness to actually raise the interest rates or tell the politicians in DC to stop printing so much money to tame inflation. And what the higher interest rates actually does is that by raising the interest rates, it makes the government deficit more expensive, which then makes it more expensive for us, the taxpayers, because we are the one who's funding government. So by raising the interest rates, that causes a problem. And I know I'm going on a little bit of a lot of data and information here, but one point, Joe, I want to mention is that if you actually go back to the 1970s, when inflation was really bad. Now, also, I would like to say that the data, if CPI was measured the same way it was during the 70s, we'd have the same inflation rate, meaning that inflation would be considered double digits today, but we exclude housing out of the CPI index. So that's why the inflation numbers on a year-over-year percent are actually lower. But when you actually look at that inflation data, you're seeing things like in double digits increases on a year-over-year basis. And when this was going on in the 70s, Paul Volcker stepped in, who was actually assigned as the Fed chair by Jimmy Carter. And so I know Jimmy Carter gets a lot of beef as a bad president, but he actually put Paul Volcker in as the Fed chair. And Paul Volcker ended up raising the interest rates. And because inflation was so bad, it actually, and the interest rates were so high, it actually caused Jimmy Carter to cut the deficits going into the election year. And he got a lot of backlash at the time for that because they said that he was turning on his constituents, meaning like he was cutting off like welfare checks. Basically, he was trying to cut off that money supply that was going to his voters to reduce the overall inflation for all.
For sure. And I think that begs the question, what on earth does the incumbent do? I hate to get too political, but if the deficit right now is widening and widening and widening, and prices aren't coming down, what does the incumbent do? Does he let asset prices continue to rip and then pretend that that's the real economy and let the pain continue at the pump, or does he fight the deficit and then bring about a more slower growth environment? What on earth does he do in order to get out of this pickle? Because it seems day by day his approval rating is falling as a result of mostly, just like you said, prices at the pump.
No, absolutely. So, sadly, I haven't, here's an interesting fact. The last president to actually raise taxes to help fund the government was George Bush Sr., and he lost the re-election in 92 because he raised taxes. And, so the American people, don't like taxes and they don't like inflation for obvious reasons. But politicians believe that they're better off with inflation because most people are uninformed on what causes it. So it's better for them to go the inflation route and blame geopolitical consequences, natural disasters, anything in there, and anything except for the national debt and the deficit. And so most people aren't aware, and so they, I guess, will continue to do that until like a true tipping point happens. And so that's why I said that when I was looking back at the numbers in like 2018, 2019, and you're looking at the national debt rising so fast. Now, I do have to say that I do love that if you're going to fund, deficits, at least, let me keep more of my money that I make versus for lower taxes. But that also incentivizes productivity. So if your taxes are lower, that may incentivize you to work more because you get to keep more of what you earn and produce. But if taxes go up, why would I want to work more? Why would I want to seek a higher job if I'm just going to be taxed more? And so you're actually starting to see those consequences play out where people are making decisions because they just don't want to pay the price. I think recently, if you saw the 401k dollar amount for the average American is actually down from 2021. So when you were mentioning that the S&P is at record highs, the average American's 401k balance is down and withdrawals out of their 401k is up. And so when you see that this inflation crisis is doing to Americans, they're looking for more money to pay for their expenses. And so you have the S&P at record high, but Americans' 401k balance is on a median is below the 2021 highs. And so you take that, and then you also add in inflation because inflation since 21 has been 20%. So if your accounts aren't 20% higher than in 2021, inflation is just really hurting the average person out there. And so going back to your
Absolutely.
question, this crazy, it's just that there's so much information. As far as what do politicians do, based on what I've been seeing, is that they'll just continue what they've always been doing, and that's why I say that you need to have a balance of being debt free, owning assets, because they're going to continue to print money. And then when you look at their deficit today, no matter who is president going forward, because I haven't heard anyone say about to reduce the deficit. That would be a thing in breaking news, but they're not going to lower the deficits. And so if the deficits now are averaging over 2 trillion a year, We know that Social Security can't be funded. We know interest rates on that debt can't be funded. So we'll just continue to keep doing what we're doing until a tipping point. And so to me, that is the crisis, is that this is going to continue on. And we may not get a Weimar hyperinflation where prices go up 200% or 300%, but we could get this constant 10% and 10% annualized inflation. And what I mean by 10%, I mean the cost of real world goods, not that's what's being reported on the CPI report. And so that compounding effect is going to have like a very long lasting effect, because very few Americans actually can handle the compounding effects of inflation. And so we're already at reported 20% inflation since 2021. And many people are not, net worth isn't up 20% since 2021. And so when you don't have that increase in your net wealth, but the prices of everyday goods that we use are up 20%, you need to play catch up. You need to get to that 20%. And by the way, the Fed says we're not getting inflation at 2%. We're trying to get to 2%, meaning we're going to constantly have price increases. And so you're falling further and further behind. And that's causing this compounding effect that's also will hurt markets as well, because we're seeing it. If inflation is taking away discretionary spending, that means that the overall market's earnings are going to have to go down because people are spending less money.
Very well said. So in this environment, what on earth does the average person do? Like you said, they're playing catch up, getting rid of debt, owning assets, because right now asset price inflation is the only thing that's shielding people from the cost of everyday goods. If their net worth is going up, then they're somewhat insulated from this. So what kind, of course, not financial advice, but in an environment where deficits aren't going to be shrunk because politicians need to get reelected, and so they'll elect to allow inflation to run hot so they can continue pumping asset prices by funding an ever-widening deficit. What should the average person own in order to insulate themselves from this?
Well, I don't want to give into any specifics, but one of the things is having a nice balance of and so in the industry, you have a portfolio. So I'm definitely not for one to say you should own just one asset, but you should have you would break down your portfolio based on your risk assessment for an individual, right? So someone who's 60, who maybe has a nest egg, is going to have a different portfolio versus someone who's a 20-year-old or a 25-year-old who's just starting out, right? So like a 25-year-old, a 5% bond does no good, right? And so, but a 60-year-old with $1 million, a 5% bond will do them, pretty solid. So it's not necessarily like a one-fit-all financial advice for everybody. So everyone is different. But I would have to say that everyone should have some sort of real asset in their portfolio, no matter what their age is, as like a store of value. And then I'm not going to say exactly what some people want to call as a store of value, but things that are limited in supply, something that has demand going forward in the future, and so. I'll just say that gold has just hit a new record high, and so one of those things that has multiple uses, industrial use, investment use, central bank use. It also has actually, if it's funny, gold is used mostly for jewelry. So the number one use for gold is jewelry, and so a nice balanced portfolio is definitely the way to go. So it's not a one asset or one investment strategy that fits all. And so that risk across the age spectrum is what's important. And what's most important now, no matter what your age is not to be in debt. Because if you're in debt paying interest, you're never going to get ahead. And so that would be the best advice I can say that would be actually one size fits all for everybody.
Very well said. Very good advice. And I can completely attest to your point about interest in getting yourself out of debt immediately. My student loans, which thankfully I've almost totally paid off, but when I took them out in 2020, 2021, I'm only paying, and it's still very hefty, I'm only paying 7 or 8%. But I was looking at credit card rates out of curiosity, and most are over 30% from what I've seen. It could just be my credit score, but I've paid off the debt that I do have on time. But 30%, the average person's not going to be able to claw their way under if they regularly have a credit card balance that's anything over $2,000 or $3,000. They won't be able to catch up. One thing I do want to talk to you about. You sent over the SOFR chart, specifically the SOFR and Fed funds spread chart. And I'll actually pull that up right now so viewers can see exactly what I'm talking about. The last time that we saw the spread between SOFR, which is one overnight rate, and the Fed funds rate, which obviously the Fed controls, blew out was right when the Fed started cutting in 2019. We also had some minor turbulence during the March 23 banking crisis. But recently, and as you pointed out, on April 1st, we had yet another spike where SOFR rose above the federal funds rate. So talk to us about what's happening here, what you see going on with SOFR Fed funds.
Yeah, and so this is really important. So this is actually what I was the one who asked Jerome Powell back in 2019 about the repo market back at the NABE conference in Denver, where he said that they were going to buy government bonds because this is not QE. And so what that means is the world financial systems, and I'll try to make this so that everyone understands it, no matter what the financial level is that the world financial world, they do things as overnight lending. And so what that means is we'll use this as an example. I'm JP Morgan and Joe here is Citibank. Well, I need to clear my books at the end of the day, and I need an extra $100 billion to clear up my settlement. Well, Citi says, we'll give you the $100 billion, but we need collateral. And so what I'm going to do is I'm going to give my collateral, which we'll say is a U.S. government bond or a US Treasury, to Joe at Citi. And I say, here, I will lend you this bond and pay you interest of whatever the SOFR rate. Now, what SOFR rate is supposed to do is supposed to stay flat, meaning it's a guaranteed. Now, when it spikes, why would it spike? That's when Joe says over at Citi, well, I think JP Morgan, Greg, may not pay me back. So I'm going to want a higher collateral because I'm not sure if I'm going to get paid my money back. And so that's when the interest rates actually spike. And why is it spiking? They're spiking because they're not sure of either A, the collateral that they're receiving, meaning that the value of it isn't actually worth what you're telling me it is, or B, they're afraid that their partner that they're borrowing from or borrowing to will not be in business tomorrow. And so that demands a higher interest rate. And so what happened was both times during March 2023, when Silicon Valley Bank collapsed, we had that rise again. And obviously we knew that there were many banks, Silicon Valley Bank, First Republic, PacWest, Signature Bank, were all holding these pieces of paper that were worthless, and that these companies or banks were on the verge of collapse. And so the interest rates spiked. The same thing happened in 2019, except way higher, because that was right before the Fed intervened with $100 billion of overnight repos. And so that got the rates back down. And so as far as why this is important, we're starting to see it spike today. So it's spiking today. Well, what happened between March of last year and today is that the bank term funding program at the Fed expired back in March. And so the banks were able to go to the Fed through the BTFP and exchange poor assets, say a bond or a mortgage-backed security that lost 50% in value, and get 100 cents on the dollar. And that program ended, and now those banks now have to pay the Fed back. Not only that, but you're also dealing with the issue that now they have no more exchange swaps on these toxic assets that are sitting on the Fed's balance sheet. And we're also seeing that rise in the discount window. And Jerome Powell, the Fed chair, has said, banks, please use the discount window. But by going to the discount window, it exposes to the banks that are possibly on the verge of some sort of crisis.
Because it reveals their identity, whereas BTFP was an anonymous facility. And so how does that change the
Correct.
dynamic? Do you think we're going to see more and more frequent disruptions to SOFR? And if we do, what does that mean for the Fed? I talked about the Fed maybe cutting rates for financial stability because of the inversion of the yield curve. Do you think that there's going to be, or do you think that there's a chance that these disruptions to SOFR become more frequent and perhaps the Fed needs to intervene in overnight lending again?
Oh, absolutely. Without a doubt in my mind that that's eventually going to happen. Now, whether or not they create a new facility is another story because the banks can go back to the discount window, but if they're going back to the discount window and they're exchanging bad assets for money from the Fed, they're not getting 100 cents on the dollar, right? So if they still have toxic assets that are on their books that lost, 50% of value over the past 2 years, you know, before they were getting 100 cents. Now they're only getting a one for one on their swap. And so that's not going to be enough money for the reserves. And Jerome Powell has stated a couple of times in his Fed conference pressers that he's paying attention also to the reverse repo and also the Fed's balance sheet. So when we're talking about the Fed stepping in, and I can actually send you some of those clips if you want for your viewers, is that Jerome Powell said when reserves on the balance sheet get to a certain level, which I think is somewhere around 300 to 400 billion, then the Fed would stop the runoff on the balance sheet and then step in basically and be what the reverse repo has been doing for the Fed, which is actually quantitative easing. And so, and what I mean by that is that the banks had, I think, somewhere around $2 trillion sitting at the parked in cash at the Fed, and that money has been coming out of the reverse repo. And where has that money been going? Well, it's been going to things like buying bonds, getting it guaranteed, 4 or 5% over the long term. And so that's been a major driver of buying bonds over the past year, year and a half. And so the Fed's balance sheet, which has shown declines, but they're not selling treasuries. They're letting their treasuries and their mortgage-backed securities just mature, meaning that as soon as they reach their expiration date, they're buying less than what was rolled off. And for example, if $100 billion of treasuries expired this month, the Fed could still buy 50 billion of new treasuries, but it'll show a net negative 50, and that will show their balance sheet actually declining while they're still buying bonds, which they have been buying bonds. And Jerome Powell has made it clear that they're just letting treasuries roll off their balance sheet and that they're not net sellers of treasuries, which to me would be actual quantitative tightening. So,
Absolutely. Absolutely. The Fed can't sustainably exit its role in the US Treasury market. If it became an active seller, I think we'd see absolute mayhem and a total reversal of that. Greg, this has been excellent. You are an absolute, you know, you have so much knowledge on all of these subjects, and each of your answers to my questions and the statements that you've gone on have been excellent. What do you want to leave our viewers with, right? Ending this discussion, obviously a great deal of information. We talked about the deficit. We talked about the path forward for the Fed and the US Treasury, the debt situation. How do you think this all shakes out over the rest of the year? And then maybe even, your outlook even further into the future? And what would you advise, people to do or to learn in order to prepare for all of this?
yeah, thank you, Joe. It really has been a pleasure discussing all the things that you brought up today to inform your viewers and hopefully many more people. And what I'll have to say is that, the one thing that is certain is that the US dollar will lose purchasing power every single year, right? So it's like, what do you do with that information, knowing that the dollar will lose, at least 2% in purchasing power every year? So that means A, you either need to cut back your lifestyle by 2% a year to maintain the same purchasing power or your quality of life, or you actually need to exceed 2% in your revenues to outpace or beat inflation, or you need assets that will surpass and give you more yield or return on your investment of more than 2% a year. And that's at 2%. And I'll leave you also with this, that inflation on an average, even when taking in the data from the 1970s, has really been about 4.5%. And so really, to me, I think a good gauge, which by the way, if you look at the increase in debt or the deficit, that is on average how much we increase the deficit every year or the debt every year. So, when people ask me, how do we know what prices will go up? I say, just look at the debt and deficit. How much did it increase? Because that's more money in the system. And so if we're averaging these 4.5% increases every single year, that's really the rate of inflation. And so basically you need to keep more, for the average person, keep track of your monthly cash flow, be out of debt, and making sure that you have investments that yield you more than 4% a year, which makes it hard because there's not a lot of yielding assets that will last. Meaning, like, you can buy corporate bonds or corporate debt, but those things, you don't know if a corporation will be bankrupt because of the issue that we're dealing with today, where some banks may pay 4% in dividends, but we're on the verge of maybe some of them announcing more issues or dividend cutbacks because of their financial situation. And so it's really hard for the average person to get just a 4% return. I mean, our normal savings account for Americans today don't even earn us 4%. And that's actually what's causing the issues in the banking sector today, is that the bank runs aren't that people want to pull their money out of the banks and put it underneath their mattress. They want to take their money out of their savings account and put it in money markets, put it in treasuries, put it in the stock market, put it in other assets. And so the bank run, and we're seeing these, I forgot what the deposits withdrawals were, but they're still being withdrawn. And that means that the banks don't actually have any of the money that they say they have. And that, to me, they're blatantly insolvent. And so they're doing similar tricks over the past year with the BTFP, where the banks needed cash, they needed money. And so they went to the BTFP and they took these toxic assets off their balance sheet, got a loan from the Fed, and they marked up their balance or their financial statement saying, hey, look, we have this much more money than we did last quarter and the previous year. But in reality, they just took out a loan from the Fed. And this is very similar to what Lehman Brothers did when they were in the same situation with Repo 105. And it wasn't until the very end that they were like, oh crap, we're insolvent. And then, everything came falling apart. So by keeping, those things intact, by being debt free, trying to be smart with your investments, and then improving your financial wealth via cash flow positive every single month is the best way forward.
Excellently said. We'll leave it at that. Greg Crennan, Chief Economist at Golden Coast Consultants. Excellent stuff, man. It was a great discussion. Last thing, where can people find you in order to get more of your content, more of your information?
Great. So you can definitely go to some of my social media accounts, which everyone is on. Golden Coast Consultants, or I just ventured into a economic Austrian news called the Coastal Journal, where you can get weekly news updates on the markets, the economy, get more insider information on what's going on, the information you're not going to see from legacy media, these in-depth information and charts and data that Joe pulled up today. I kind of go over in the Coastal Journal to inform the masses, which is the fastest Austrian economic news source right now in social media.
Fantastic. And I can attest, I do read the Coastal Journal. It is a very good read, guys. So make sure you go check that out. Follow Greg on Twitter. His handle, if you're watching this on X, his handle is in the title. If you're watching this on YouTube, his handle will be in the description. But once again, thank you guys so much for watching. Of course, download Theya, your keys, your Bitcoin, simplified self-custody. If you've been on the fence about Bitcoin self-custody, make sure you go to the App Store, download it today. It's free, but it won't be free forever. So make sure you download it before that happens. Greg, once again, thanks so much for coming on the show. I'll talk to you soon.
Thanks, Joe.